In today's video, I'm going to explain how accounts receivable turnover ratio works, including the formula, an example calculation, and how to improve your turnover ratio. I'm Priyanka Prakash, small business expert and senior staff writer at Fundera. Accounts receivable turnover ratio basically tells you how good a job your business does at collecting on invoices. Many small business owners, especially B2B businesses, bill their customers using invoices. Customers normally get a specific period of time, 30, 60, or 90 days to pay those invoices. The faster customers pay you, the better it is for your business's cash flow and financial health. Let's dive right into the accounts receivable turnover ratio formula. Accounts receivable turnover ratio equals your net credit sales divided by your average accounts receivable. In this formula, net credit sales means the portion of your annual sales that are tied up in invoices. Instead of receiving immediate payment for these sales, you extend credit to your customers for these sales. To get net credit sales, you take your gross sales and subtract cash sales, customer returns, and other allowances for customers such as price changes. Average accounts receivable refers to the average amount of money that customers owe to you throughout the year. To get this number, you can take the dollar amount of accounts receivable that you had at the opening of the year and add the dollar amount of accounts receivable that you had at the end of the year. Then divide this sum by 2 to get the average accounts receivable. Now, accounts receivables are considered assets, so you can find all the numbers that you need for this formula on your business's balance sheet. Let's go through an example to better understand how accounts receivable turnover ratio works. Here is a balance sheet for a fictional business, ABC Bakery, that shows the start of year assets and liabilities and end of year assets and liabilities. To calculate the accounts receivable turnover ratio, I only care about the accounts receivable row on the balance sheet. In this case, ABC Bakery started the year with $15,000 in accounts receivable and ended the year with more money, $30,000 in accounts receivable. This shift can happen if your company has an uptick in sales as the year is ending. Let's assume that ABC Bakery also had $100,000 in net credit sales for the full year. To calculate the accounts receivable turnover ratio for ABC Bakery, first calculate the average accounts receivable. Add up the opening year accounts receivable, $15,000, and the end of year accounts receivable, $30,000, and divide by 2 to get the average accounts receivable, $22,500 in this case. Next, plug your numbers into the accounts receivable turnover ratio formula. Take the net credit sales of $100,000 and divide by the average accounts receivable, $22,500, to get 4.44. This number means that ABC Bakery's accounts receivable turned over 4.44 times in the past 1 year. If you take the 365 days in a year and divide by this accounts receivable turnover ratio, you get 82. That means it took, on average, 82 days for ABC Bakery to collect on each invoice. So what makes a good accounts receivable turnover ratio? Ideally, your business shouldn't take longer than 30 days on average to collect on each invoice. The ideal amount of time, of course, could differ based on industry and the stage of your business's growth, but in general, a higher accounts receivable turnover ratio is usually better than a low ratio. A business with a high accounts receivable turnover ratio tends to have stricter credit policies and is more efficient at credit collection. If you have a low accounts receivable turnover ratio, it usually means that your credit policies are not strict enough or that you're having issues with debt collection. Less commonly, a low accounts receivable turnover ratio could mean that there was a problem with a particular shipment of goods that led more of your customers to refuse payment. So don't necessarily blame your credit collection staff for a low turnover ratio. Now, the best way to improve your accounts receivable turnover ratio is to have and follow sound credit collection policies. Basically, your goal is to get clients to pay you as soon as possible. These are a few tips to encourage your customers to pay invoices more quickly. Send your invoice immediately after a job is complete. Give clients online payment options to reduce the friction of payment. Offer clients early payment discounts. Charge late fees so clients feel pressure to pay you faster. Ask for deposits up front. Send periodic, friendly payment reminders to your clients. And don't work with habitually late paying clients. For more advice on how to improve your accounts receivable turnover ratio, also check out our video about unpaid invoices. In that video, we cover several strategies to collect on debts more quickly. After watching this video, you should now know how to calculate your accounts receivable turnover ratio. This ratio gives you a good look at an important part of your business's cash flow. It's a good idea to check your accounts receivable turnover ratio at least once per quarter, maybe even more often, so you can take steps to improve credit collection if there's a decline in your ratio. For more small business finance tips, visit Fundera.com. You can also go to youtube.com/FunderaLoans and subscribe to our channel for more videos. Feel free to ask questions and leave comments below. We're happy to help.